Welcome to a new wave of entrepreneurship. I'm Latifa Farah, Associate Creative Producer at Venture for Canada and the producer of a new wave of entrepreneurship. The focus of this podcast is to hear from changemakers and Canadian entrepreneurs to learn about how they've developed their entrepreneur mindset and skills. In Season 7, we'll be chatting with CEOs, founders, and successful business leaders about their career journeys. We're excited to dive into these conversations about how to foster your entrepreneur mindset and drive. On this episode, we're joined by Christian Lassonde, a serial entrepreneur who has started 4 technology companies prior to Impression Ventures. Christian is the founder and managing partner of Impression Ventures, a venture capital firm focused on investing in companies that either improve current financial products or develop new products that ultimately provide lower cost or better access for consumers. On this episode, Scott and Christian will discuss learning how to interact with venture capitalists.
It is a pleasure to have Christian Lassonde on Venture for Canada's podcast, A New Wave of Entrepreneurship. Christian, how are you doing this morning?
I'm doing fantastic. Thanks for asking.
I am really excited to have you on the show today. And one of the questions that entrepreneurs frequently have is how to interact with VCs, how to pitch for venture capital investment. So, Christian, what is the most common mistake that you see entrepreneurs make when pitching for venture capital investment?
It's a great question. There are so many mistakes that founders make, and I should say they're all little mistakes. But probably the most common little mistake is assuming the investor knows far more about not just your business, but your area, your focus of business than they actually know. So I generally try to help founders avoid this mistake by guiding the conversation early on to really explain. I ask them to explain to me not only what exactly are they doing, but why they're doing it, because I think the why is super important. Early on in my VC career, I didn't do that, and oftentimes I get to the end of a pitch and I'd be scratching my head. I'm like, I'm not sure I know exactly what these guys even do. I mean, we talked about numbers, we talked about finance, we looked at their app, but I'm scratching my head here, wondering what they're actually doing and does anyone even care? And so I think it's really important. At the core of venture capital in many ways is this concept of whatever you're doing needs to be 10 times better than what consumers or businesses are solving that problem with today. And this is oft repeated for decades now. I mean, I remember this 10x number, early on in my tech career. And being able to, in that first conversation, especially with a VC, really explaining to the investor on the other end what it is you're solving and why it's 10x better and why that's important. I think people sort of assume that the VCs already know this and they just skip that step too often. And I think it's a very simple mistake to fix, but one that I see very often.
One topic we have talked a little bit about on this podcast in general is around founder market fit. And to your 10x%, yes, there's an idea, there can be IP, but the extent to which a founder or founding team can be uniquely suited to tackle a specific problem, which in and of itself can potentially create a competitive moat. To what extent do you think that founder market fit is something that is critical for venture capitalists to look at when considering whether to make an investment or not?
Well, I think I look at our own portfolio, and there's a very tight knit between the background of the founders specific to the industry that they are disrupting. So they tend to have deep domain expertise in the area that they're disrupting. It's something they've been doing for minimum 5 years, sometimes 10, sometimes even 15 years. They've been working in that industry, and there's some nut in there that they have been banging their head against for a decade, and they woke up one morning and said, I'm so tired of this stupid thing that we do in this industry. I'm going to fix it, and I'm going to fix it by creating a startup. Those are the ones that do have founder market fit. They deeply understand not just the problem, but why the problem exists in the first place. Because problems just don't exist in a vacuum. They exist in an environment. They exist in an ecosystem. The ecosystem has built up to support that this problem exists. There's probably reasons why it exists, structural reasons. And without understanding the structural reasons of why this thing exists, why this problem exists, you can't fix it. You can't just build a better widget and expect the ecosystem to adopt it, just out of the blue. There's probably inherent bias towards the former way. Well, in fact, there is inherent bias to the former way. People probably like the stupid way they're doing it today. And you have to convince them that no, that's a really bad way of doing it. Try my way instead. And so having that domain expertise really helps companies overcome that inherent bias against change that exists in every single industry.
It's interesting. It's perhaps one of the most common topics I've had with various Venture for Canada fellows over the years, where so many young people who are 21, 22, approximately that age, feel so much pressure to go launch a business like tomorrow. But to your point, most venture capitalists, or most people who found venture-backed companies, or are in their late 20s or older, and have to some extent a domain expertise in the industry that they're going to create. It's to say, obviously, there's exceptions to the rule, but I guess when you're looking at a first-time founder, let's say it's potentially a first-time founder who's like right out of university, how do you look at founder market fit when an individual perhaps has little to no domain expertise in a specific industry?
We really don't look at age or years since graduation, if you will. What we look for is, has this individual had that deep industry insight, and that can come very quickly after. I mean, we've seen that happen very quickly after graduating university. In some cases, even because they've had a co-op placement and they've in that co-op placement really pushed themselves to really understand the nature of the industry that they're working in and the players within the industry, and they're just actually at that point really well suited to solving that problem. So I would say in most cases, the vast majority of the population, that sort of insight only comes later on in their careers. But it's not exclusive to later careers. You can do that earlier on in your careers. But I agree with the statement. I think we are pushing too many young Canadians to get into venture, to start a venture well too early in their careers, when my advice is generally go master something first, then go change it. That said, I'm do what I say, not what I do, because the very first thing I did out of university was start a company, and I call it my complete failure, because I knew nothing. And actually, that's where I learned that lesson, because I went out, I started this company, I was a great programmer. But that's it. That's all. I had no idea how to run a business. I know nothing about business. And a year later, the thing flames out. No surprise. And I just sort of was, in a state of shock as I realized just how little I knew about business, life, everything. And it was a great learning experience. So at the same time, I'm like, there's nothing inherently wrong with going out and starting a company right out of university. Your chances of success are astronomically low, but if you can pull it off, it's a fantastic learning experience. It certainly was for me.
And to your point, there is no one path. There are a million different paths, and each person is different. Shifting back a little bit to the storytelling piece, and it's something that I've often heard is some of the most compelling entrepreneurs are people who are excellent storytellers. How do you think entrepreneurs can use effective storytelling to raise venture capital or other kinds of investment?
Yeah, I'm not a big fan of the storytelling narrative. It's not incorrect, but what I've seen in the last decade is you can tell a story that's fiction and you can tell a story that's nonfiction. Fundraising is fundamentally a nonfiction story. In fact, it has to be a nonfiction story. And I think too many people have heard the storytelling narrative and decided, oh, well, I can tell a fictitious story. I can make things up. But we read great nonfiction works all the time. In fact, I'm reading one right now that's super, super interesting. storytelling is about packaging information in a digestible narrative. And I think that's really what people need to focus on is how do I explain the arc of the achievements that we've made so far and the view of the future that we have and how that all fits together in a narrative that is easily digestible. And too oftentimes, again, another sort of big mistake that we see is we see founders bury the lead, right? Like they have a core piece of technology, or they have a core relationship, or you have something really core that's transformational to their business, and it only comes up at like the last, 55 minutes into a 1 hour pitch, and I'm just sort of gobsmacked. I'm like, you're waiting until now to tell me about this thing? Like, it's just sort of astounds me. And so when I'm coaching founders on how to pitch, I'm really going like, unpack your entire story. What are the highlights? What are the, like, if you think of if you're thinking of you're writing a story, you're going to have these emotional high moments in the storyline, right? What are yours? And make sure they're not at the last, you're not writing this is where the storytelling is maybe different from writing a book. You're not waiting for the last chapter, to have the climax of your fictitious story. No. This is a nonfiction. The climax, in many ways, should be at the front end. Capture people's attention. Tell them why you're different very early on, and then the rest of the narrative is really telling them about how all the various pieces fit together to have hey, we are a company that is going to transform this business, whatever what industry that we're going to transform. And we're going to succeed, and we're going to grab this massive market share, and we're going to be massively successful. And you can be a part of that. And then the even better pitches are like, and here's why we want you guys to be a better part of that. Here's why we think you guys as investors are inherently better than the other investors to help us succeed on that vision. And like, don't blow smoke up their asses. Actually do your homework and make sure that it's something that you're talking to an investor where there is a history, a reason why they would be better for you.
If an entrepreneur has an hour with a VC, what percentage of the time should the entrepreneur reserve for like the presentation, and what percent should the entrepreneur reserve for a Q&A? Or is that even a false binary that it's all intermixed together?
I think it's a false binary. I mean, and again, I think it depends. I mean, probably every investor in fact, every investor will be like slightly different. I can tell you what my preference is we come out of the gate. So we ask for the deck ahead of time so that we can review it. And what that means is so we can understand the basics of the industry, of the business that you're trying to do. And then we come out of the gate asking questions right from the get-go. And we just pepper them with questions for the full hour. So we refer back, we hope that they have the presentation there. We can refer back to them and said, on slide 10, you're talking about your market size. We'd love to understand how you got to that because it doesn't make sense to us, blah, 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 something like that. So it is, I think if we're anywhere similar to the rest of the industry, I think you're going to find that most of the hour is going to be spent being peppered with questions.
Conversely, in situations where there's a founder who has an immense amount of technical knowledge, and I'm smiling to myself because there's someone I recently interviewed on this podcast who's very technical. And in the pre-interview, I had to be like, make it so people can understand. Like, yeah, you have a lot of technical knowledge, but it's important for lay people to understand. What advice do you have for technical founders on how to communicate in immensely complicated topics in a way that a VC who might have no domain knowledge can easily understand it quickly?
Practice. Find people around you who have no technical domain expertise, your friends, your parents, your cousins, friendly people, and explain what you're doing and until their eyes stop glazing over. Keep refining your answer to those top questions until their eyes don't glaze over anymore. It's a skill. It is a genuine skill to be able to take highly complex technical things and I don't want to say dumb them down. I like to think of it more as explain them in English terms. Every industry wraps itself in a protective layer of jargon. I've seen it in every single industry that we've gotten involved in. It's they protect their secret knowledge with with mounds and mounds of jargon terms. It's just a human thing that humans do. You have to just not use any of that. You have to jettison all the jargon and find the English words for that jargon and be able to communicate in terms that are in common English. And it takes practice. I don't want to fool founders in thinking that they can just pull it off on the spot. Practice ahead of time.
To what extent should entrepreneurs pitching VCs ensure that there is time in an initial pitch meeting for the entrepreneur to ask the VC questions?
Yeah, I mean, watch the clock. And I generally sort of think of it as sort of the last 5 to 10 minutes. So 5 minutes in a 30-minute pitch, 10 minutes in an hour pitch, to ask the VC questions. I try to watch the clock. I'm not, not all VCs will be watching the clock. So watch the clock and don't be afraid to interrupt and say, hey, we have 10 minutes left. I want to, be very conscious of your time. And, but I'd like to ask you a few questions before we go. Would that be okay? And 99% of human beings will be like, yeah, absolutely, sure. Ask me questions.
What are the best and worst questions that an entrepreneur can ask a VC in that 5 to 10 minute time period?
The worst question is are you ready to invest and can I have a check now? That's probably the worst question to ask. The best questions are ones that indicate that they've actually done their homework and understand the venture world. So great question that I love hearing is out of what fund are you investing and how much capital do you have left for new checks? Again, it shows that they've done their homework. They know they're trying to spend their time wisely with people who have the ability to write new checks into new companies. But that's just one example of a question. Another great question is, does our company fit your current investment, your investment thesis? Just off the top, like at the very basic level, does what we do fit within your bucket of things that you invest in? And not asking whether you're investing or not, just asking if we actually fit your investment thesis. And again, smart question because it shows that they're paying attention that investors have limits in terms of who and what they can invest in. And if you're not within those limits, you're wasting your time talking to them. So questions that really show that they understand that VCs aren't just people with money that give it out because they like the way you talk. That they have a process. They have to a very thoughtful process to invest the money on behalf of their limited partners. They're investors in turn. Are the questions that I like hearing because it shows to me that these are thoughtful individuals and they've done their homework.
Do you think entrepreneurs should ask VCs for feedback on how they can improve their pitch?
If you'd asked me that 10 years ago, I would have said yes, absolutely. I have become progressively more cynical over the last decade, because I'm not sure. I guess let me not rephrase the question, but reframe the viewpoint. If you're genuine about getting feedback, then yes. But my cynicism comes from the vast majority, or not the vast majority, but too many founders are asking me that question. Not because they want the feedback, because when I give it to them, they actually start challenging me on the feedback and they, challenge my integrity, my intelligence. I'm clearly wrong. And maybe I am, but you don't need to tell me that. But it's not a genuine question. What they're looking for is what is stopping me from making the investment and how can I be convinced otherwise from stopping the investment. But if you're truly genuine about that feedback, then yeah, ask for it. But you may find the VCs just don't want to give it because they've been burnt too many times by founders attacking them on that feedback.
An important rule for life in general: when you ask somebody for feedback, don't debate them. Just smile and think about it. And it's to say that one doesn't need to agree with all feedback that's given, but if you ask for feedback and you debate it, it doesn't necessarily send a good message to the other person. But I think people who I've often find it's a good judge of somebody's character and potential, how they respond to feedback. And if they respond immediately defensively, it's a sign of a little bit of like lack of impulse control. Okay, because they're just jumping to their first, which is our natural human instinct, which is often to get defensive, some more than others. But I find it's helpful in performance reviews and other things in life when thinking about that. One other topic that I'm interested in thinking about is when entrepreneurs pitch VCs, if they pitch 100 VCs, they're likely going to get like 95 plus no's, right? Or 100 no's. What do you think is the best way an entrepreneur should respond to a VC when they receive a no email or no call?
So first of all, you pitch 100 VCs, and this is my experience as a 4x founder. More than 60% you will never hear back from. So you won't actually even get a no. You'll just be ghosted. And so the first mistake that a founder can make is that a no reply means you still have a chance. It's a no. It's just not an explicit no. The other 40% or 39%, because you're going to get that 1% that says yes, and this is what I remind founders: you only need one yes, right? And so all those no's can be very hard on the psyche, but you don't need yes from everybody. You just need one yes. The other 39, the best responses I get are thank you for your hopefully prompt response, but thank you for your response, appreciate it. And sometimes you can, and maybe that's it. That's all you need to say. Just thank you for the response. Appreciate it. When I'm out pitching for our fund and investors tell me no, that's what I say. I say, look, I appreciate your response. Actually, it puts you in the top investors out there that you just actually thankfully responded to me on the yes or no answer, and that's appreciated. You can go a little bit more than that. You can say, would you like me to update you on our progress after this round? Would you be interested in the next round? Because some funds invest in multiple rounds. So a fund might pass you on the seed round, but they could maybe be reinterested in the A round. So you can often ask. So if it's a fund that does seed A and B, and you're raising for your seed, and they say no, your seed, do you want us to reach back out when we go out to raise our A? And again, some funds will reply yes, some will just ghost you, and some will say no, that's it, we're done, we don't ever hear from you again. But honestly, short, sweet, to the point, thank you. That's all you need to provide.
How often do VCs give maybe as a response? And what I mean by that is to say, we're interested, but we want to see your company continue to grow and develop, so keep us in the loop.
That's it's probably fairly common. I don't recall having a bunch of maybes, but maybe they're more like the not right now emails. It's like, what we like, this is where like we really like what you're doing. So I think the nature of those emails will be much more along the lines of, we really like what you're doing. Come back to us in a month with how your traction is going. So it's not really a no, it's not really a yes, it's not even really a maybe, it's a not right now. And that'll be fairly common. And that's a no, by the way. And you as a founder have to decide whether or not you want to keep them updated. The vast majority of founders will say, yeah, it's the optionality of keeping them updated is worth it. So yeah, we should.
Interesting. Yeah, and I can imagine if one sees that up and to the right and significant growth over time, there's a potential for somebody to shift their mind over time.
Absolutely. And hey, guilty as charged. There are times when there's companies that we've been lukewarm on and we've seen fantastic traction, and then yeah, we change it's not so much change our minds, but we saw the signal we were looking for to invest. And frankly, there's nothing wrong in my mind. There's nothing wrong with that. And so, yeah, if they're looking for a specific signal, they may not tell you what that signal is, but if they're looking for a specific signal and they see that in one of your monthly or quarterly updates, then yeah, it could very well, shift them into that, yes, we're ready to invest now stage.
Let's say a company has raised a seed round or a Series A round from a group of institutional investors, and they're looking to raise their next round of institutional funding. How can an entrepreneur leverage existing relationships with current investors to help raise that future round of investment?
Number one, keep in touch with your current investors. I think, the easy mistake to make is, receive the money and then go to your current investors, 18 months later when you're raising your next round and go, hi, remember us? Would you put more money in? That's just a dumb mistake. You should be keeping them updated, not just by email, but calling them, developing a relationship with them, because what you want is going in, in fact, you should then be showing them the next round deck and saying, what do you guys think of this deck? Does it hit the high points? Does it, are you guys interested? You have a relationship. They now have an inherent bias towards the company succeeding because they're investors. They're going to provide you the best unfiltered feedback early on in that next fundraising process. So if they're hesitant on the next fundraising round, expect to have a really hard time fundraising. So keep them apprised, get continuous feedback on it, and hopefully they will be early advocates of your next round because of the success you've had. And you should absolutely be leveraging. In that case, you will be able to leverage them because they're going to be telling their friends and their other investors, like their co-investors in other companies that they're in, hey, you really got to take a look at company XYZ. We watched, we've been investors of their company in the last 12 months and they've been doing fantastic. And here's the latest report. And you really should take a look at them. So best case scenario, you've be kept in touch with them. You've kept them apprised. You've really pulled them into the feedback loop of building the narrative for the next deck. And they're out there as champions for your next round.
So to the point about investor updates, I'm sure you've probably seen hundreds of different ways that people send these emails. And I imagine that different companies require different structures. What's a general template approach in terms of email updates that you think works well when entrepreneurs are keeping VCs abreast of changes?
The format that I find is most universal, and again, to your point, every industry, every company is slightly different, every industry is slightly different. You'll have to modify this, but I like the wins, losses, asks, and bullet point format of here are our accomplishments, here are our wins. Again, pick your term you prefer. Here are misses, losses. Again, pick your term you prefer. And here are asks from you. And that tends to capture in a very short amount of time, with brevity, the highs and lows of what's going on. And make sure you add the lows, because first of all, investors, unless they've, this is their first investment ever, period, the end, fundamentally, life is messy and there are no highs without lows. If you ignore the lows, your believability as an individual just goes down. So the lows are there to, in some ways, provide a balance to the highs, to really provide context of like, how high are these highs? Well, we don't know how high those highs are without knowing what the lows are. So highs and lows, really important. And then the asks, look, you have a fantastic network of investors. That's why you have, in many ways, why you have investors. Don't expect every investor to answer every single ask, but at least put them out there. I mean, at least make people aware of what it is that you're looking for, how you need help, and that you might hopefully get more than a couple of answers and a couple of pushes and nudges to the next level.
One question to wrap up this interview, and it's the Peter Thiel inspired question. What is one commonly held belief about raising venture capital that you disagree with?
Again, I'm not sure it's widely held belief, but I've certainly seen the last decade and a half the the congratulatory emails around fundraise, as if the end milestone has been achieved. That we've gotten the unicorn valuation, the mega round, we've made it. You haven't. You're just getting started. And there is way too much hype in the media around funding rounds. And look, and I don't want to dismiss them. They are an important milestone. I mean, they do unlock the next level of the company, but you've just unlocked the next level, and now you got to play the next level. You got to actually do it. So I'm not a big fan of the narrative of we've made it because we've done this funding round. It's hey, we got a lot of hard work ahead of us. Now we got to go do it.
Christian, it's been a pleasure speaking with you. We've covered a wide range of topics on how entrepreneurs can successfully raise funds from venture capitalists, including how to use storytelling or not use storytelling, nonfiction, exactly, how entrepreneurs can keep their existing investors regularly abreast of situation, how entrepreneurs can deal with rejection in a way that's classy and maintains their reputation and provides a potential for future relationship. Christian, a lot of really actionable advice. Thanks so much for coming on the podcast this morning.
My pleasure.
That's it for this week's episode of A New Wave of Entrepreneurship. Stay connected with us via our socials and our email list. Subscribe to us in your favorite podcast app so that you don't miss our next episode. If you have feedback on today's episode, tweet us at Venture for Canada, that is Venture, 4, Canada, or email us at podcast@venture.canada.ca. We'd love to hear from you. Thanks for listening. I'm Latifa Farah, and that was Scott Sturrett and Christian Lassonde. Until next time, stay safe, stay motivated, and stay grateful. A New Wave of Entrepreneurship is produced by Latifa Farah, and editing and mixing are also done by Latifa Farah. Basola Agamba is our editorial assistant. Mark Wallach and Premium Beat own the copyright and publishing rights related to the song used in this podcast.